Okay, we are in chapter 4 for Accounting 211, and we're going to be talking about accounting for merchandising operations specifically. A merchandising operation is a specific type of business. Merchandising versus manufacturing is typically how you would look at it, or merchandising versus manufacturing versus a service-based company. Here we'll give you just a quick comparison between the two, service companies versus merchandising. We're going to be talking all about manufacturing once you get over into Accounting 212. But look at what a service organization does. It sells time to earn revenue. Like what I do at Foltz & Associates. We're an accounting firm. We don't sell anything. We don't sell tax returns. It's not the paper that we're selling. We're selling the service that we provide. So typically what you would find on my books, at least on my income statement, I would have straight out revenues minus expenses, and that's how we would calculate net income. But on the other hand, what a merchandiser does is earns net income by buying merchandise and then reselling that merchandise for a profit. Therefore, what you'll see down here for a merchandiser is that we have this intermediate piece that you don't see in the service company. What you'll see for a merchandiser is that they take net sales minus the cost of those things that they're selling, and that gives us gross profit. So net sales minus cost of goods sold equals gross profit. We have an equation there, and then we take this gross profit minus expenses equals net income. It stands to reason then that you could also just get rid of this piece if you wanted and say net sales minus cost of goods sold minus expenses equals net income. Same thing. So a merchandiser can be really that piece in the middle. Typically, merchandisers are going to be considered the wholesalers or the retailers. A lot of times retailers will get their goods from a distributor that buys directly from the manufacturer. So there's a lot of different ways that can work, but it's usually the middleman that becomes the merchandising company. Here's what that reporting of income with that graphic that we just saw would look like on the income statement specifically. And again, it's still the same equation that we've seen before. There's net sales minus cost of goods sold. Now gives us gross profit. This is a pretty important number for you to understand. Make sure that you get that in your head. Sales minus cost of goods sold get you to gross profit. And that's how we're going to present it on the income statement for a merchandiser. Okay, so if a merchandiser is purchasing goods, you really need to visualize how that happens. The merchandiser goes out somewhere, either orders stuff or picks stuff up, brings it back into their store. Visualize a store, and that store is full of shelves, and that shelves is full of merchandise. Those shelves are full of merchandise. Well, what is that merchandise? Is it owned by the company? And the answer is yes. It is something owned that has value, and you know at this point that we call those assets. So a merchandiser takes cash and purchases merchandise inventory, that stuff that the merchandiser is going to put on the shelves, and then he sells it. Don't worry whether it's a credit sale or a cash sale, doesn't matter, but he sells it, and that becomes more cash, and he makes more purchases of inventory, and he sells it. That's the cycle that we're talking about. We have to talk about inventory systems and what really that looks like. And there's a lot going on with different inventories, we'll see, but also you have to think about a couple of different aspects of a merchandiser. A merchandiser wears two hats. One of the purchaser, where it goes out and buys things at cost, and one of the seller, flips the hat around, and now we're the person who sells those things for a markup at a profit. But let's talk about inventory. This graphic can be a little bit confusing, but let's just think about it now. If you take whatever you already had in inventory, by the way, if you're a brand new company, this would be 0, and you add any new purchases of inventory, that gives you what merchandise you have available for sale. And then if you take away whatever you've sold, that should give you your ending inventory. And that's why they've given it this graphic. Merchandise available for sale has already been sold and is now as a cost of goods sold, or it is still sitting and inventory. We'll see that a little bit more in a minute. You need to understand that there are two types of inventory systems. The perpetual inventory system is what you see every day when you go to Walmart or any type of establishment where they're using scanners, or that gun, the infrared gun. That's a perpetual system. What's happening is every time someone clicks that gun, inventory counts are changing and the value of inventory is changing. Either there's someone in the back room as a receiving truck comes in and merchandise is coming off the truck into the back storeroom. Someone is clicking those SKU numbers and bringing that inventory value into the accounting system. And then up at the front of the store at the checkout counter, again, we're swiping those items across that scanner, and now inventory is going down by one. That's a perpetual system. It is continually being updated. A periodic system is the one that's different. It's the system that I really grew up on because back in my day, they didn't have scanners. We didn't have computers in stores. We had hand crank or barely electrified cash registers at that point. They were not accounting for our inventory for us. My mom and dad owned a grocery store. Believe me, they were not constantly writing down how many cans of peas they sold. That would have been a perpetual system. If every time someone bought a can of peas, they wrote down someone bought a can of peas and now I only have X number of cans of peas left, that would have been perpetual. But instead they used a periodic system, which means that the inventory was only accounted for and updated at the very end of the accounting cycle. Here we're going to talk about the purchasing side of things. Let's just focus on that for a minute. Turn your head around to the front and say, I'm the purchaser. I'm going to go out and I'm going to buy inventory and my ideas that I'm going to resell it later. So as a purchaser on November 2nd, we're working for Z-Mart, and Z-Mart purchased $1,200 of merchandise inventory for cash. How do we record it? Okay, merchandise inventory is an asset account. We know that increases by a debit. So a debit goes to that account of $1,200, and we're going to credit cash $1,200. That makes sense as well because cash is going out the door. We're relieving cash, right? And cash decreases by a credit. So that makes pretty good sense to us. You have to understand what happens on an invoice when you purchase goods. There's a lot of pieces and parts on this. I really only want you to focus on a couple of things. Just understand that all of them are necessary, but two things primarily we need to look at are the terms here and then the freight, because these two things are going to change how we account for specific purchases. Not to minimize anything else, but you certainly should always take notice of the date of the invoice. Remember, accounting is set by a time constraint, and time is very, very important in accounting. So noting that this invoice gets recorded in November of 2015 is quite important. So let's talk about purchase discounts. This is a deduction from the invoice price granted to induce early payment of the amount due. What does that mean? Okay, I've purchased inventory, now I have an invoice and I have, 30 days to pay it. But the person who sold it to me says, hey, if you will pay me sooner than 30 days, I'll give you a discount. And that's what we're talking about when we see the purchase discount on that invoice. What this 210, it seems very cryptic, doesn't it? It's like, why do we have to be so cryptic? Well, yeah, a long time ago, people were writing invoices with, pencil and paper or using typewriters. So a lot of times acronyms or these different formulas or functions were created that made sense to the people who were reading the statements, and probably don't seem quite as applicable these days, but it is still there. 210 net 30, what does it mean? It means that the seller is going to give us a 2% discount if we pay this invoice within 10 days. Otherwise, we have to pay the whole thing or the net amount at the 30-day due date. So the whole thing is really due in 30 days, but you're incentivized to take a 2% discount if you pay it in 10 days. That's what 210 net 30 means. So let's expand the example. On November 2nd, Z-Mart purchased $1,200 worth of inventory, but purchased it on credit. Didn't pay cash for it this time. And the invoice gave us terms of 210 net 30. So the purchase looks the same, except we're not using cash anymore. We're buying it on credit, so we're going to post it into accounts payable. Same thing though, the $1,200 goes into merchandise inventory. Now you might want to think, oh, but they're giving me a 2% discount. Why can't I go ahead and take 2%? Why can't I go ahead and take $24 off of this invoice when I record it? And the rules say that even though you may intend to take this discount, you record the invoice at full price, because good intentions sometimes never come to fruition. You may never actually take it. And truly, on November 2nd, you owe someone $1,200, not $1,200 discounted to 2%. So you're just going to book it at full cost value. But then there on November 12th, we paid the amount. Remember, we're Zmart. We paid the amount that was due, and we paid it within that 10-day discount period. So what do? First, we have to relieve accounts payable for the $1,200. It went on in the previous transaction as a credit, so I have to take it now out of accounts payable as a debit. Skip this middle line for a second. Let's just look at the cash. I decided to take the discount. That's $24 off of $1,200, so that's $1,176. So even if I didn't know what to do here in the middle, I could have figured this out. I have to relieve the $1,200, but I'm only going to pay $1,176, and then it becomes a question of what do you do with the other $24 credit. In the purchasing side of accounting, it's very simple. Any adjustments to your inventory must go directly through the inventory account. So we simply adjust the discount directly out of that inventory account. Remember, inventory went in as a debit, comes out as a credit, and we are adjusting the value of inventory down by $24 with this discount. Same thing, it's just telling you everything that I said. All right, here's what it looks like after we post these entries. Here's November 2nd. I posted the inventory in and I had an accounts payable. Then on November 12th, I paid it. I relieved the payable by the entire amount, giving me a balance of 0. Now I've discounted my inventory down $24, and my inventory value is $1,176. So it seems to work. Okay, what about purchases, returns, and allowances? Here's something a little bit different. Every once in a while, you need to return something. Maybe it was defective. Maybe you just ordered too much and you didn't need it. That would certainly be a purchase return. An allowance would typically be for something that is defective or unacceptable. How do you deal with it? Same transaction. We bought $1,200 on November 2nd. We paid the bill on November 12th. And here we are, November 15th, Zmart, we're the buyer. We issue a $300 debit memorandum for an allowance from Trex for defective. It means that $300 of it was no good to me. Maybe I called them and said, hey, this stuff was bad. What do you want to do? And Trex says, you know what, I'll give you a $300 credit on your account. Just go ahead and reduce the account, what you owe me, by $300 or put a credit in there. That would be the debit to accounts payable. But where do I put it? Well, it's a credit to merchandise inventory. Inventory itself is going to be devalued by $300. Okay. So just expanding it, Zmart purchases, here's the whole thing. Zmart purchases 1,000 merchandise on June 1st with terms 210 net 60. 2 days later, returns $100 of goods before paying the invoice. When Zmart later pays on June 11th, it takes the 2% discount on what's remaining. Here's the original purchase. It was a $1,000 purchase on June 1st. On June 3rd, I asked for a $100 credit against the account because I found some defective material. So I reduced the accounts payable by 100, reduced inventory by 100. The point of this example is, how do I calculate the discount once I get down here to June 11th? How do I calculate that 2%? Well, the 2% cannot be taken on the 100. The 2% must be cannot be taken on the 1,000. It must be taken on the 900 here. So that 2% of 900 is $18. You paid out cash of $882. All right, that dealt with the terms on the invoice. The other thing that I showed you on the invoice was to look at that shipping, that whole FOB thing, or what the shipping terms were going to be. And typically you'll see either FOB shipping point or FOB destination. And what happens is that one of these, they always tell you when ownership transfers from the seller to the buyer. So an FOB shipping point, ownership transfers when the goods are passed to the carrier. So at the point that the seller puts it on the truck, it becomes the items of the buyer. The buyer now owns it. As soon as it leaves this dock and gets on this truck, the buyer owns it. So if it's FOB shipping point, then we need to put the cost of transportation into the inventory. Okay, that's the rule. If ownership transfers right here, which is FOB shipping point, we put the transportation expenses into merchandise inventory. Otherwise, if it's FOB destination, it tells us that the transportation or the ownership doesn't transfer to us until it leaves the truck and comes to the buyer's dock. Okay, that's a little bit different. In that case, we're just going to call the transportation expense delivery expense, freight and shipping, whatever it is that we're calling, whatever title we have on that account. So if it belongs to us as soon as it gets on the truck, we put it in inventory. If it belongs to us as soon as we get it on the dock, then it's an expense. Okay, here's what it looks like. Z-Mart purchased merchandise on terms of FOB shipping point. That means it belongs to us as soon as it gets on the truck. Therefore, our inventory assumes the cost of the transportation, and we're just going to put it straight into the merchandise inventory account. There it is, because it was FOB shipping point. Okay, here's what it looks like. This is an itemized cost of merchandise purchases. So obviously we didn't go through all of these, but if we were to work out the schedule, this is what it would look like. The cost of merchandise, and then we would take out any discounts that we receive, take out any returns and allowances, add in any transportation that goes into inventory, and then we would have our merchandise purchases. Okay, so that said, let's move over to the other side of this and look at the sales side of things. So here is what a computation of gross profit is going to look like from the seller's perspective, right? So we were the purchaser, we purchased merchandise, but now we're still Z-Mart. We have to sell our merchandise. Well, how do we deal with the sales side of things? And this is just a preview of what the end game looks like. The computation of gross profit, and by the way, this is exactly how it goes on our income statement. We don't try to skinny this down. This is exactly how we're going to present it. We'll list out sales, and then we're going to take away sales discount, sales returns, and allowances to give us a net sale number. Then we're going to take away cost of goods sold to compute gross profit. The one thing I want you to note, when we were dealing with the purchasing side, anytime we had discounts or returns and allowances, we just took it straight out of inventory. We didn't have less purchase discounts or less purchase returns and allowances, did we? In those journal entries, we took it directly out of the inventory, but we already are getting a little bit of foreshadowing here in that we're going to have to do it slightly different. So each sale transaction from a seller of merchandise is going to involve two parts. So when you're selling stuff, you're going to have to create two journal entries. The first one is to record the revenue received, and you either received cash and credited sales, or you received an accounts receivable and credited sales. That's all well and good. We know how to do that. But then over here it says, wait, you also have to recognize the cost of the inventory now as an expense. And that's what this truly says. This doesn't even make sense, right? But we need to recognize the cost of the inventory as an expense. This is what I'm saying to you. The merchandise inventory is an asset. It sits on the shelf until a customer comes and picks it up and brings it to the cash register. When it's sitting on that shelf, it's an inventory asset. It's on the balance sheet. But as soon as a customer buys it, the cost of that inventory needs to be removed from that inventory asset account and become a cost of goods sold expense on the income statement. Question is, how do you do it? Well, it's probably just a pretty simple journal entry, right? Here's going to be the example. Z-Mart sold $2,400 worth of merchandise on credit. The merchandise had a cost to Z-Mart of $1,600. Break that down. It means that Z-Mart bought whatever this was for $1,600 and stuck it on a shelf with a price tag that said $2,400, and now I've sold it, right? That's what it looks like. 2 entries required. The first one is I sold it for $2,400. We know how to do that. But the second part of that transaction is that I have to take that $1,600 off the shelf. It has to come out of assets, and it has to go to the cost of goods sold, which is an expense type account. We just saw it on the income statement. This is an expense type account. So I'm moving inventory over to the income statement so that I can write this expense away from my revenue. Look, sales is a credit, expense is a debit. Sales minus expenses equals what? Well, if you go a few slides back, it's gross profit. So, again though, just like on the purchasing side, we can have sales discounts, we can have sales returns and allowances. The biggest difference here though is that when we have those terms, we have to record the discounts and the returns and allowances in a completely separate account. Under inventory, we just put the discounts and the returns and allowances straight through the inventory account. But with sales, we want to see those discounts and we want to see those returns and allowances totally separate from sales. We want to be able to see this so we can see how much we offered in discounts. Was it worthwhile offering our customers an incentive to pay early, right? That's why we want to see it. But the returns and allowances, by the way, are not great things. Anytime a customer returns something, we have to wonder, was something wrong? Did they just order too much or was something wrong? And allowance especially. Did I sell a defective product? I want my reader of my financial statements to see that outright. Let's just walk through this real quick. Z-Mart completes a $1,000 credit sale. Terms were $210, net $60. It was $1,000, right? I've sold it. There's my accounts receivable. They're not showing me the cost of goods sold yet. That's kind of interesting, right? Option 1 is the account was paid in full within the 60-day period. Okay, well, if it was within the 60-day period, which means it was well after, you see that, November 12th to January 11th was well after the discount period of 10 days, we simply get the cash for $1,000 and we get rid of the accounts receivable of $1,000. But if it was paid within the 10-day discount period, I got to still take the receivable off the books, but I'm going to get that cash less that 2%, which is $20, and I'm going to record that to sales discounts. Sales returns and allowances, exact same thing as purchase returns and allowances. Because there's something wrong, a dissatisfied customer, bad merchandise, no good quality, defective merchandise, whatever's going on, the returns and allowances is not necessarily for a good thing. But like sales discounts, we want to see it separately. Here's a Z-Mart sale for $2,400, had a cost of $1,600. Let's assume that the customer returned part of the merchandise. The returned items sell for $800 and cost $600. What are we going to do? The first thing is that we have to reduce the revenue side. They no longer owe us this $800, but instead of taking it away from sales, I'm now going to push it into this new account called sales returns and allowances. And then I'm assuming that it wasn't defective inventory because I'm going to put it right back on the shelf and try to sell it again. I put the cost back on the shelf and reduce it out of my cost of goods sold. But what if the buyer decided to keep it? Or what if we told the buyer, you could keep it, right? We don't want it back, it's defective, do what you will with it, take it to the dump, whatever. So we offer them a $100 price reduction. Well, now they don't owe me the $100, and I'm just going to put the $100 in sales returns and allowances and make no adjustment to my inventory because I never got the item back. By the way, sales returns and allowances and sales discounts are both considered to be contra accounts. What does contra mean? Well, contra means the opposite. The opposite of what? What does sales do? Sales is increased by a credit, which means that sales returns and allowances and sales discounts are going to reduce sales. That means they're going to do the opposite thing that sales would do. If sales normally has a credit balance, a contra revenue account will normally have a debit balance. Okay? So, This says, let's prepare adjustments and close the accounts for a merchandising company. So you've already seen how to do adjustments. You've seen how to close accounts. We did all that stuff in Chapter 3. We've already looked at all of that. But what's going to be different now that we're looking at a merchandising company and not looking at a service company? This graphic's kind of crazy looking, right? All this is showing you folks is the accounting cycle from period 1 to period 2, right? So it's the same kind of thing going from period 1 to period 2. Let's go ahead and take a look at it. Merchandiser using a perpetual inventory system is usually required to make an adjustment to update the merchandise inventory account. What does that mean? It means even though you've got those little scanners at every cash register and you've got the scanners at the back room receiving, inventory has a really phenomenal way of walking out the door without ever getting scanned. What does that mean? It means maybe somebody stuck it in their pocket, maybe it was broken when somebody was messing with it on the shelf and it left it on the floor. In any case, our system has never been told that that inventory doesn't exist anymore. So even if using a perpetual inventory system, a virtual or a real count, a physical count of all inventory needs to take place at some point to determine what the true count is and what the true value of inventory is. In this case, in this example, there was a $250 shrinkage in inventory. That means that once they counted inventory, they looked at the books and saw that inventory was listed at $250 more than it should be. The rules say that when you adjust inventory because of a physical count or any kind of count, that you simply adjust it into cost of goods sold directly. In this case, merchandise inventory needed a credit of $250 to be adjusted appropriately. We just plug it in to cost of goods sold. Here are the closing entries. Remember that closing entries deal with the temporary accounts in accounting. So we're going to look at those accounts that need to be reset to 0 for the beginning of the next accounting cycle. What accounts are those? Well, those are revenue and expense accounts plus the dividend account. Those are the only accounts that we ever close. Well, what's different for a merchandiser over a service company? Well, a merchandiser, instead of service revenue, has sales. That's a temporary account. Also has sales discounts and sales returns and allowances and cost of goods sold. Also, all temporary accounts that need to be closed down to 0 before you can continue on. Okay, finally, we're just going to look at the multiple step and single step income statements. This isn't hard, folks. Just want to go ahead and point this out. You'll see that things are now quite indented. Remember, an income statement is a financial report. These columns do not mean debits and credits on a financial report. The readers of our financial statements don't understand debits and credits. That's what we're supposed to do. But this makes it easier for them to read when they can see sales, and then they can see what makes up net sales. It was this $321,000 minus this $6,300, but this $6,300 was made up of these two things. That's the only reason it's indented, to bring it down. Then the selling expenses are subtotaled, general expenses are subtotaled to give you total operating of 42.1 plus 29.3 equals this number. That's all we're talking about there. In a single step income statement, I'm going to go back one slide, look at the net income here, right? And notice all of the totals. Notice these totals, okay? Now I'm going to go forward. Here they are. Net sales, total revenues, cost of goods, selling expenses, general expenses. See that? Same thing, but everything is collapsed down into very broad categories. That's the only difference. I'll go back one more again. That's the only difference between a multiple step income statement, which gives us the gross profit computation, income from operations, and non-operating stuff, versus our single step income statement, which just jams everything together in one great big financial. Classified balance sheet, we talked about the classification last time about current assets and long-term assets and what they mean. Classified balance sheet, the only account that's going to be different is the merchandise inventory. It is considered a current asset, not long-term. And that, folks, is going to be the end of Chapter 4. I know that we pushed on through that pretty quickly just for video's sake. I guess the beauty of this is that you can pause and rewind and go back and kind of review some of that again. Stay tuned though, there will be another video for the group work for Chapter 4.